Want to pay less in taxes this year? Well, this is why we're making this video today. One of our goals for every one of us is to pay as less as possible each year. We want to reduce our taxable income as lower as possible. This is why this video is for you today. 5 ways W2 workers can lower their taxes in 2025. Let's get started. The very first strategy that you can use to help save you in taxes each year is to max out your 401k. So that is the number one strategy that anyone can follow. If you have an employer who offers you a 401k plan, then it's time to rethink and put more money into it if you have the cash flow at the end of the day. The very first component of this strategy is to ensure that you have enough money in the bank to pay for all the operational expenses throughout the year. You don't want to go ahead and put more money than you should and then run out of cash during the year. That's not a good strategy at all. So you want to make sure that you have enough money in the bank before you make this decision to put more money into your 401k plan. So if your employer offers a 401k, it's a good idea to put as much as you can. Again, before you have enough cash to pay for those operational expenses, go ahead and put that money in the 401k because it is a good idea, and I'll tell you why. Number one, if you put money in the 401k, it can defer your taxes in the future. So the more money you put in, the more money you defer in taxes, and you're not paying any tax on that money at all to the IRS in that year. So right now, the maximum you can put into a 401k is $23,500. That is the max you can put in a year. In 2025, at least that is the number that you can contribute. Of course, that number changes every year. For future numbers, you'll see a higher number coming in. If you're 50 and above, you can put another $7,500 just as a catch-up payment. So that is another advantage. If you are 50 and over and you have the capacity to put money, you can definitely go ahead and utilize that and put more money in. So another benefit of the 401k plan is you're deferring taxes, yes, but at the same time, you're putting money into a 401k plan that would of course grow. So there's financial aspects to it, and then there's tax savings to it at the same time. So the tax savings work in this way. When you put money in the 401k through your employer, what happens is your W2 wages would get reduced by the same amount. So the box 1 in your W2 would be subtracted from that amount that you put in, and then your tax would of course get lower. So the less wages you have in that box 1, the lower your tax liability would be. So this is how it works. The more money you put in, the more money gets deferred, and then you pay less taxes on your W2, on your personal taxes when you file your tax return. Now, I'm sure a lot of us don't have enough cash, of course, to max the 401k out each year, and that is totally normal. This is what happens with most of the taxpayers, of course. They don't max their 401k out because they don't have enough cash in the bank. But if you do have cash in the bank, then there's no point keeping all of that cash in the bank. It's not giving you the return that you're expecting it. Of course, it's not bringing any tax savings. So keeping it in the bank is not a great idea. And that is why if you have the capacity, it's a great idea to put that money in a 401k and get those tax savings. But again, make sure you don't go over the limit that the IRS has for each year. But at the same time, you can utilize that this strategy and basically saving taxes each year. So make sure if you have the capacity and you have cash in the bank, go ahead and put that money in the 401k so it can work for you and make money for you, but at the same time, you get tax benefit that year. Yes, of course, you're going to have to pay taxes later down the year when you retire, but your tax rate might be really low in that year when you retire. Of course, you're not going to bring that much money in. So in that case, yes, it's a good strategy because later when you retire and you're not making that much money, your tax rate will be lower, so you'll pay less in taxes when you retire. Right now, when you're aggressively making above 100k, 200k, for example, your tax rate right now is higher, so you want to reduce that tax rate, and that's why it's a good strategy to put the money in the 401k and defer those taxes when you retire and make less money. Now, the second strategy or the second thing that you can think of doing is an HSA plan or an FSA plan. So what is an HSA plan? An HSA plan in a short run, I'm not going to go ahead and describe it in detail in this video because the video is going to go too long, but an HSA is basically a health savings account that you can use to put money in for medical expenses only. So there's a drawback for HSA. if you're not expecting medical expenses in the near future, then of course it's gonna sit there, um, not do anything. But again, it will lower your tax liability, of course. So that is a plus point. But again, that money can only be used for medical expenses. So you have to look at the drawbacks, but at the same time the benefits. You can use that money any time in any year. The good thing about an HSA plan is that it can hold the money in it forever. So you don't have to take the money out. There is no use it or lose it like FSA, which I'll explain in a bit. But with an HSA, yes, the money will stay in. You can only use it for medical expenses when you withdraw the money, or there's penalties involved if you don't do that. But yes, it will give you tax savings, and then it's like an investment for you for medical expenses whenever they come up for you or your dependents. So it's like another good strategy. Right now, I think for 2025, the maximum amount that you can put in into an HSA is $4,300 for single taxpayers. Basically for yourself only, or for family coverage, you can go up to I think 8,300. $8,330. But again, those numbers change. So you want to make sure you look on the internet, the most recent IRS information about that. Make sure you don't go over that. So as long as you stay under that, you're fine. You can go ahead and put money into an HSA plan, and that would also contribute as a tax saving. If you do it through your employer, of course, those tax savings will be pre-tax. They'll reduce your wages accordingly, and then what happens is your W2 will reflect that, and you'll get taxed less. Your income will go down. If you go out in the market and get an HSA yourself, then you can do that as well, and then in that case you'll get a deduction on your tax return, in Schedule 1 as a above the line deduction. So again, you can get that deduction on Schedule 1 on your tax return, or it goes through your W2. No matter the case, HSA is another way you can save money each year. Now, an FSA, on the other hand, is called a flexible spending account. The reason why I don't recommend an FSA is because if you don't use the money, you lose the money. So there is a really big drawback with an FSA, is that you can't carry over the entire amount next year, compared to what you can do with an HSA. So with an FSA, there's only a certain portion of the amount that you can carry over next year, but then it gets lost next year if you don't use it. So this is why this is the biggest drawback with an FSA. FSAs are only basically sponsored by employers. They're offered by employers. HSAs, you can get an HSA in the market yourself, or your employer can offer you. But with an FSA, you have to really think about that investment. In terms of medical expenses, if you don't have an immediate medical cost in the coming year or this year, it's not worth it to put money in FSAs. That's why I usually don't advise clients to put money in an FSA. I would rather have you put the money in an HSA, which has a higher amount too. The FSA limit is $3,300 only. HSA has a higher limit, so you can definitely look into it more. But I would recommend putting money in an HSA if you really want to invest some money for your medical expenses and get tax savings at the same time. It's not a bad investment if you have cash on the side in your bank account. Now the number 3 strategy, and it's not like a strategy, it's more like an advice at the end of the day, is that a lot of the people are making this huge mistake of not calculating their tax liability or not projecting their tax liability. Why do business individuals only have to calculate their tax liability each year? Like, they have tax planning softwares that they use basically to estimate the income that they'll be making in this year. They try to project their taxes by projecting their income for that year. You can also do that. So a lot of the mistakes that I see with W2 workers, that what they're doing is that they are filling that W4 form and then they hand that over to their employer or their the HR department, and then they forget about that. What happens is, with that, you might have filled it right, you might not have filled it right, and then you end up being short when you file your taxes. So one consideration to make in that is, your W4 withholdings do not consider your investment income at all. Like, Your employer is not going to know if you make interest or if you make dividend income or you have stocks on the side that you're investing in and you're going to get some capital gains this year. All of these factors do come into account and they do matter. So this is why I recommend using the IRS free withholding tool. So they have a tool where you can basically use the IRS calculator to make sure to see how much your income will be this year, and based on that you can put your W2 wages, you can put interest income, dividend, and all of that income. It's a pretty good tool that the IRS has. It's absolutely free, so you don't have to basically buy a complicated tool to project your tax liability. So go ahead and use the IRS free tool, withholding tool, and I would say see what your income would be this year, and then based on that it will help you project your tax liability, and then you can see if you're actually withholding the correct amount through your job or not. So you can check that in your pay stub. You can see the number that you're withholding each pay period. You can just find out the number you're contributing each month, then each quarter, and then you can see if you're paying enough each quarter, because at the end of the day you have to keep in mind that IRS, they want you to pay your taxes in 4 equal quarters, and that's how they assess penalties as well. There's another really there's another great strategy. It's called safe harbor. I would recommend you go online and you look at safe harbor. I'm not going to describe safe harbor too much in this video because the video is going to go too long again. But safe harbor is basically if you pay a certain amount next year, then at least they don't charge you penalties and interest or anything like that. So you can avoid penalties that you pay at the end of the year when you don't pay enough taxes. You can avoid that if you pay safe harbor. So safe harbor is you can pay, of course, 100% of your tax, which we don't know, of course. Or you can pay if your annual gross income is above a certain point, which is, I think it's $150,000. If it's above that, you can pay 110% of your last year taxes. And then there's some more clauses in safe harbor. Again, you can go ahead and look at that. But I think what we recommend our clients is to just pay safe harbor at least, which is, I would say, don't look at the AGI. Just pay 110% of the tax you paid last year in 4 equal quarters this year. So take 110% of what you had last year in the tax, and then just divide that by 4 and pay that in 4 equal quarters, and you should be good. At least you won't get charged a penalty at the end of the year. Now, another key point in optimizing your W4 withholdings is that you also have to make sure that you're basically considering your dependents properly, and you're also, when you're using that IRS tool, I would recommend that you also consider credits that you would be claiming, and then again any payroll deductions or pre-tax savings. If you account for that, you'll get a better projected tax liability, and what that would do is you won't overpay in taxes. You're not going to give IRS extra money that they'll have with them interest free. So we don't want to overpay that much that IRS has all our tax savings and then they're keeping our tax money, but we also don't underpay them. So we want to make sure that we're paying them just enough. Like you want to pay maybe $500 more, or maybe a max $1,000 more, but not anything above that. So this is like a safety net. So don't overpay them like $6,000, $8,000 that they have, and you could be using that money, and again you could be putting that in the 401k like I told you in the strategy 1. So you want to keep most of that money with you and not overpay IRS for no reason. Now, strategy 4 is, of course, standard deduction or itemized deduction. This is one of the biggest issues each tax year that we face, deciding if we can itemize or we can't itemize. Now, if you have mortgage interest, property taxes, state taxes, you have donations, you have medical expenses, and then with medical expenses, there is a 7.5% annual gross income clause. If you're the 7.5% of your adjusted gross income is taken into account, and anything above that is given to you as a medical expense. Anything lower than that is not given to you. So there's that issue with medical expenses. that whatever is above 7.5% of your AGI is given to you. If it's not, then it's not given to you. So with medical expenses, there is that issue. But what I've seen is that if you have property taxes, you have state taxes, you have mortgage interest, donation, all of that stuff, you might not be able to itemize still. And this is a huge problem that taxpayers don't understand is SALT cap. Unfortunately, we have a SALT cap on property tax, state taxes, sales tax. So in that bracket, the max deduction you can take, unfortunately, right now is $10,000. So let's say you have just a hypothetical situation. You have $5,000 in property taxes. You have $8,000 in state taxes. Now that amount is huge. It's going above 10,000 clearly, but the IRS would only give you $10,000. So this is the max you can take in the itemized deductions section. So if you see the form itself, there's a section where you have your property taxes, state taxes. In that particular section, you can only take 10,000. Now for mortgage interest, there is no cap on that. So yes, you'll be able to claim that fully, and then donations, you can claim them as well. If they're cash donations, yes, you can claim them fully. Again, there's more clauses there that we're skipping right now, but in a nutshell, you might not be able to itemize, which is unfortunate. And I think a lot of the taxpayers that I work with, they have all of these deductions that they could possibly be claiming, but unfortunately, they're added to these itemized pool, and if you can't itemize, you can't use them. And this is how sad the reality is with taxes. Is right now these deductions are not a separate deduction. They're in this itemized pool, so either you get the itemized or you get the standard. And most of the people, if they're married, standard deduction will be 30,000 this year. So you won't be able to cross that threshold, and you're going to lose all your property tax, your mortgage interest, your sales tax is going to get lost. So this is why if you have all of these numbers going above 30,000, if you're married, or if you're single, 15,000 is your standard deduction this year. And I think for single people, yes, if you have above numbers, you would be able to get that itemized deduction. Of course, another benefit for you, it will help you get a little more savings in tax. So go ahead and check and make sure you have enough itemized deductions and you're claiming them and not losing them when you're doing your taxes. Also, it's a great idea, and this is one of the biggest tips that I give everybody who's using a DIY software. If you have itemized deductions like property tax, state taxes, you have mortgage interest, donations, and charity, you want to make sure that if you have state, your state might offer you itemized deductions even though you can't get that on the federal side. So this happens a lot. We have taxpayers who are married. Of course, their standard deduction is way too high. They can't get itemized deductions, but then on the state side, state has a lower threshold. So they get this itemized deductions on the state side. Now in your DIY software, if you skip this section, if an expert gives you an advice, hey, looks like your itemized are not enough, you won't be able to get them on the federal side, you don't have to enter them. What happens is you lose all of those deductions on the state side too. So it's a big mistake. I've seen many people making this mistake, that yes, they're losing the itemized deductions on the federal side, but they don't enter them because they think, oh, we're never going to cross that threshold, but they don't think that the state has a lower threshold for itemized deductions. So go ahead and make sure that you're using your itemized deductions to get better deductions on your state return. And this is why we don't recommend DIYs again. Now, last but not the least, the fifth strategy is payroll fringe benefits. I would say if your employer offers you fringe benefits, it's time to maybe look into them. If you want to save a little more in taxes and your employer offers some fringe benefits like HSA, like I mentioned, if your employer offers it, maybe you can look into that. FSA, again, I don't recommend FSA because if you don't have medical expenses coming up in this particular year or next year, you're going to lose it. But again, FSA is an option. You have commuter benefits that some employer offers, dependent FSA. For dependent care, of course, if you have child care, you can look into that, of course. What that will do is you're gonna get tax benefits. It will be payroll deductions, but then you won't get charged tax on them. So your wages will go down. So this is why all of those payroll benefits that your employer offers, it's time to look into those fringe benefits. And if there's something that maybe aligns with your goals, I would say go ahead and look into that and put some money in, so that way you can save on taxes. Well, this was it for today's videos. These were 5 basic strategies you can use as a W2 worker to help lower your taxes in this upcoming season. Go ahead and leave a comment for me. Let me know if you need any specific advice on any specific topic. I'll be more than happy to share my insights. Go ahead and drop a comment. Let me know what surprised you the most, which strategy surprised you the most. I would love to hear your comments. Go ahead and follow us for more tax videos like these, and there will be a lot more to come in the future and help you save in taxes. I'll see you on the other side. Have a great day.